Wow. Just wow. If you've been watching the markets lately, well, we've seen some movements that feel less like trading and maybe more like
hmm
history actually unfolding in real time.
Absolutely. It's been pretty dramatic.
Yeah, I mean, just last week, we saw the S&P 500 and the NASDAQ composite indexes surge over 10% in a single day.
Incredible
Think
numbers.
about that for a second. A double-digit gain in, what, 6.5 hours of trading? According to one of the sources we've been digging into, moves like that magnitude, they're incredibly rare.
Vanishingly rare, really.
They rank among the top 10 single-day percentage gains of all time for those indexes. I mean, we're talking about the kind of seismic shifts you only saw, a handful of times before maybe the Great Depression or the depths of the 2008 crisis.
Exactly. These aren't just daily market fluctuations. They are really dramatic history-making swings.
When you see market behavior on that kind of scale, the immediate reaction is often to look for, well, the single massive economic event, right?
Yeah.
Or the big policy announcement that triggered it.
Yeah, you're searching for that smoking gun, that one clear cause. And it's true. Fundamental economic factors, news headlines, they are absolutely critical drivers of market activity. They definitely provide the underlying context and, the perceived value.
But our deep dive today, and we've pulled from a really rich stack of sources here, it suggests that the story isn't just written in the numbers or the quarterly reports or the GDP figures. There's something else, a powerful, often unseen engine that can drive markets to these extremes.
Exactly. And for this exploration, we've synthesized material from quite a range of perspectives. We've got rigorous academic research, stuff published in journals like the International Journal of Research Publication and Reviews, referencing studies from places like the Journal of Economic Perspective.
Yeah, the serious academic stuff.
Yeah, but also insights from very practical finance analysis tools, some groundbreaking new research actually coming out of Vanderbilt Business, and even high-frequency data like the Daily News Sentiment Index from the San Francisco Fed.
So a real mix.
A real mix. And what this diverse collection of sources collectively highlights and helps us unpack is the profound and sometimes really surprising impact of the human element in finance.
It's acknowledging that behind every trade, every stock price, there's a human being, right? Or usually a lot of them, with thoughts and feelings, hopes, and, well, fears.
Mm-hmm.
So our mission in this deep dive is really to move beyond the purely rational models, the spreadsheet view, and truly understand how the collective mood, this prevailing sentiment, how individual psychological biases and even subtle uncertainties can push markets, sometimes quite violently, away from what traditional fundamental analysis alone might predict.
And crucially, what that means for you.
Exactly. What does it mean for you, whether you're making investment decisions for, say, retirement, or maybe trading actively, or even just trying to understand the forces shaping your financial world?
So we are diving deep into how investor psychology moves American stocks, really exploring those non-rational forces that are just as real as the balance sheets.
Okay, let's start at the beginning then. We hear the term market sentiment thrown around constantly. It feels kind of intuitive, like a general vibe. But how do we define it more concretely? What exactly is this mood of the market?
Well, think of market sentiment as the overall psychological disposition or maybe the attitude of investors towards a specific security or maybe a sector or even the market as a whole at a given time.
Okay.
It's the aggregated feeling, basically. Is the dominant mood one of optimism, confidence, a willingness to buy? That's what we call bullish sentiment.
Right? The bulls are running.
Or is it dominated by pessimism, by fear, a tendency to sell? That's bearish sentiment. It's really that snapshot of the collective mindset at that moment.
So if fundamental analysis is about, like, the intrinsic value of an asset based on its earnings, growth potential, assets, all that stuff,
Yeah.
sentiment is about how people feel about that asset or the market right now.
Precisely. And critically, as our sources really emphasize, sentiment isn't just a passive reflection of the fundamentals. It's an active force. It's influenced by a really broad spectrum of inputs.
Like what sort of things?
Well, of course, major news events, political developments, company announcements, global crises, and economic indicators like inflation or employment figures, they're hugely important. They provide the raw material for investor reaction.
Sure, hard facts.
But what's becoming increasingly clear, and it's a key focus of this deep dive, is the growing influence of less traditional factors. Things like discussions swirling on social media platforms, the emotional resonance of news headlines, and the collective, sometimes kind of irrational reactions of millions of individual market participants.
So Twitter feeds and Reddit threads actually matter.
They contribute significantly to shaping that overall market move, yes. These elements are becoming major inputs.
This really is where behavioral finance steps in and kind of challenges the older, more traditional view of the market, isn't it? Because traditional economic theory often suggests or assumes that investors are purely rational actors
Yes, perfectly logical beings.
whose sole aim is just to maximize profit based on complete and unbiased information, like economic robots.
That's the fundamental departure behavioral finance makes. And it's a point stressed repeatedly in the research we reviewed, including that study in the International Journal of Research Publication and Reviews. Traditional models are, well, they're elegant in their assumption of rationality.
They make for nice equations.
They do. But behavioral finance looks at how real people actually behave when making financial decisions. It explicitly acknowledges that our decisions are heavily influenced by inherent irrational behaviors, by a range of predictable cognitive biases, and by raw human emotions.
So these aren't just little quirks or anomalies.
No, the evidence shows they are significant, systematic drivers of market movements and outcomes, not just footnotes.
It's saying the spreadsheets and algorithms aren't the whole story. Our messy, emotional human brains are running a big part of the show.
Exactly. And this dynamic is perfectly captured by the concept of animal spirits, a term referenced in the material we looked at, often associated with the economist John Maynard Keynes.
Ah, yes, animal spirits.
It describes those sort of spontaneous bursts of optimism, confidence, or conversely, those waves of pessimism and fear that aren't necessarily tied to a rational analysis of fundamentals, but can nevertheless spur investment activity.
So just a feeling takes over.
Pretty much. When positive animal spirits are running high, maybe fueled by a popular narrative or just widespread optimism spreading through social media, they can push asset valuations far beyond what traditional metrics might suggest.
Creating bubbles.
Sometimes creating bubbles, yeah, where price decouples significantly from underlying value. And conversely, negative animal spirits can lead to panic selling, driving prices down irrationally, even for fundamentally sound assets.
Animal spirits, it really vividly describes that almost primal emotional energy that can just take hold of the market.
It truly does. And understanding that raw emotional dimension, that collective psychological pulse, is absolutely essential for explaining the volatility, the unpredictability, and those dramatic swings we see in markets. Because, they aren't always just about a change in earnings forecasts.
Okay, so sentiment is this collective mood shaped by news, economics, and increasingly social buzz and emotion. But why? Why are we as humans so susceptible to these non-rational forces when it comes to money? What's the psychological machinery under the hood?
Right. This is where we really dive into the core principles of behavioral finance, which the IJRP's source, among others, details quite extensively. It's basically the study of how psychological factors affect the financial decisions of individuals and, well, institutions too.
Okay.
And the key takeaway is that our brains are kind of wired with certain systematic tendencies, what we call cognitive biases, that can lead us to make predictable errors in judgment, especially in complex or uncertain situations like investing.
So less like robots making perfect calculations and more like,
Yeah.
well, humans with these ingrained patterns that aren't always logical.
Precisely. Think of them as mental shortcuts or filters. They probably worked well enough in simpler times, evolutionarily speaking, but they can lead us astray in the intricacies of modern finance. The research, including that survey highlighted in the IJR source, which involved actual investors, identifies several key psychological biases that significantly impact how we make investment decisions and, in aggregate, influence market movements.
Let's unpack some of the big ones then. What are the common mental traps that investors fall into?
Okay, well, one of the most prevalent is overconfidence bias. This is the tendency for individuals to overestimate their own abilities or their knowledge or maybe the accuracy of their information.
I know better than the market.
Kind of, yeah. In investing, this often manifests as investors believing they're better at predicting market movements or picking winning stocks than the average person. That survey mentioned in the IJR source found a really striking figure. 73% of respondents agreed or strongly agreed that their skills allowed them to predict trends better than others.
73%. That's mathematically impossible for everyone to be above average, isn't it? So most people are significantly overestimating their own talent here.
Exactly. And this isn't just harmless vanity. Overconfidence often leads to excessive trading. If you believe you can consistently time the market or identify mispriced assets, you're much more likely to buy and sell frequently,
Churning the account.
which incurs higher transaction costs and taxes, and that can really erode returns over time, often completely negating any perceived advantage. The literature review in that study points to research, like one by El Jafri, suggesting overconfidence can even influence asset valuations, particularly in less developed markets. It might inflate prices as investors undervalue the associated risks because they just believe so strongly in their own predictive powers.
Interesting.
And the survey noted this bias was particularly pronounced among younger investors, those 18-25, correlating with higher trading frequency, perhaps linked to less experience, but, high digital access to trading platforms these days.
Okay, so overconfidence leads us to trade too much and maybe take on more risk than we realize. What's another major bias we should know about?
Herd mentality. This is that powerful psychological pull to follow the actions or opinions of the larger group, even if it contradicts your own independent analysis or the data you're seeing. It's about conforming to the majority.
Safety in numbers, even if the numbers are running off a cliff.
Pretty much. The IRB survey found 67% of investors surveyed tended to invest in stocks that most people were talking about.
The classic fear of missing out or FOMO.
Yeah.
Everyone's rushing into this one hot stock, so I feel compelled to join in, even if I haven't done my homework or the price looks, totally disconnected from reality.
Precisely. Herd behavior is a primary driver of market bubbles, where asset prices get bid up to unsustainable levels simply because everyone believes prices will continue to rise, fueled by that collective rush. Think of historical manias like the Dutch tulip craze or, more recent tech bubbles. And the reverse is true too. When fear groups the market, herd mentality can trigger panic selling, leading to crashes where prices plummet far below fundamental value as everyone rushes for the exit simultaneously, regardless of a company's underlying health. The survey indicated this tendency was particularly prominent in the 26-40 age group, perhaps reflecting increased exposure to peer influence through social and online channels.
So herd behavior pushes prices to extremes, both up and down. Fascinating. What about our reaction to losing money? That feels like a big one.
Oh, it's huge. That brings us to loss aversion. This is a real cornerstone finding in behavioral economics. The psychological pain of experiencing a loss is significantly more intense than the pleasure derived from an equivalent gain.
So losing $100 feels much worse than gaining $100 feels good.
Exactly. Much worse. The Ajibur survey found a very high 80% of respondents across all age groups exhibited signs of this bias.
Wow, 80%. That really resonates deeply. It's that knot in your stomach when you see a stock you own falling, isn't it?
Absolutely. And this bias has significant practical consequences in investing. It often leads investors to hold on to losing stocks for far too long.
Why is that?
Because you avoid selling, because realizing the loss is just too painful. So you cling instead to the hope that the price will recover, even if a rational analysis suggests the company's prospects are poor.
Hoping it'll come back to break even.
Right. This can tie up capital in underperforming assets, and it affects overall market liquidity as people are reluctant to sell declining holdings. Conversely, it can also lead to selling winners too early.
Really? How so?
Because you want to lock in that small gain for fear of seeing the profit evaporate. So you take the small win rather than letting your winners run.
So holding on to losers too long, selling winners too early, both potentially detrimental to long-term returns and both driven by this outsized fear of loss.
Exactly. Another really common bias is anchoring bias. This is the tendency to rely too heavily on the first piece of information received, the anchor, when making subsequent decisions.
Okay, like the first price you see.
Often, for investors, this means fixating on the price at which you originally bought a stock.
Right. So if I bought a stock at $100 and it's now trading at, say, $70, I might anchor my thinking to that $100 purchase price and believe it should be worth that, rather than objectively evaluating its current value based on new information or market conditions.
Precisely. The Einger-Pre survey found a striking 75% of investors fixed on their initial buy price when deciding when to sell. This anchoring prevents a flexible, rational assessment based on the stock's present value and future potential.
So you might be unwilling to sell below your anchor price, even if it's the logical move.
Or you might see a stock trading above your anchor as expensive, regardless of its true value compared to its peers or prospects.
It's like our brains just get stuck on that initial number.
Yes, very much so. And finally, let's consider regret aversion. This is the anticipation of regret, which leads investors to make choices designed specifically to minimize the potential pain of making a mistake in hindsight.
Ah, the what-if factor.
Exactly. So you might avoid buying a promising but slightly risky stock because you're afraid of regretting it if it tanks.
Oh.
Or you might hold on to a stock you know you probably should sell because you're afraid of selling, then seeing it skyrocket and regretting selling too early, the I knew it
Yeah.
feeling.
Yeah, that's a killer.
Exactly right. The fear of regret can lead to inaction or just suboptimal decisions. The Adrper survey found 60% of investors hesitated to invest in new opportunities due to this fear, noting it was more common among older investors, those aged 41-60. You sacrifice potential upside or necessary action just to avoid the potential feeling of, I should have known better.
These biases are incredibly insightful because they highlight the specific ways our brains can sort of sabotage rational investing. And sources mention others too, right? Like
Yeah.
prospect theory.
Yes, prospect theory, which looks at how people choose between probabilistic outcomes involving risk, finding people are often risk-averse when dealing with potential gains, but become risk-seeking when facing potential losses.
Trying to get back to even.
Right. And mental accounting, treating different pots of money differently based on where they came from or what they're mentally earmarked for.
Like gambling with house money.
Kind of, yeah. Or the representativeness heuristic, making judgments based on stereotypes or how well something fits a pattern while ignoring base statistical probabilities. And catastrophic thinking, overemphasizing the worst-case outcomes, which the C-Source details in a case study of the China A share market crash in 2018, showing how these psychological factors really amplified the downturn.
Wow, it's a whole suite of mental pitfalls.
Yes, these are all part of the rich tapestry of behavioral finance. And when you combine the effects of millions of investors exhibiting these biases, sometimes simultaneously, the collective impact on the market is profound.
So these biases aren't just individual quirks, they actually add up.
Oh, absolutely. They contribute significantly to market volatility. They make accurate market forecasting much more challenging. They create persistent market inefficiencies where prices don't always reflect true value. And they are fundamental drivers behind the formation and bursting of bubbles and crashes.
So those massive history-making swings we started with, while the fundamentals might set the stage, these biases can act like accelerants, right? Amplifying moves far beyond what the underlying news might seem to justify.
Absolutely. That study by Nassim and colleagues looking at stock market behavior during the initial very high pressure phase of the COVID-19 pandemic provides a really clear real-world illustration.
What did they find?
They found that the intense psychological pressure and the widespread negative feelings of the pandemic, fear for health, uncertainty about livelihoods, were inversely associated with stock market activity. Meaning that collective emotional state drove investors to reduce or completely stop investing. This very human reaction, this prioritization of life and safety over wealth accumulation under extreme duress, directly contributed to falling market returns. It really demonstrates how deeply psychology, even factors outside direct financial logic, can impact market outcomes.
That's powerful. And it directly contradicts that traditional assumption that investors will always pursue maximum financial gain regardless of the broader human context.
Exactly. It paints a picture of the market not just as a cold calculating machine, but as this complex adaptive system heavily influenced by the collective and sometimes irrational decisions of human participants.
So understanding these biases isn't just academic. It's crucial for explaining the market's often unpredictable nature and maybe for protecting ourselves from our own built-in tendencies.
It truly is the psychological bedrock upon which so much market movement is built.
So we know what sentiment is and why our psychology shapes it so much. But how do people actually try to get a handle on this elusive, ever-shifting collective mood in real time? I mean, it's not like you can just poll everyone minute by minute.
Right. That's where the growing field of real-time sentiment analysis tools comes in. As highlighted in one of our sources, the one titled 6 Powerful Real-Time Stock Market Sentiment Analysis Tools, in today's incredibly fast-paced, interconnected trading landscape, having tools that can gauge emerging trends and collective opinions quickly is becoming pretty essential.
Because by the time the official data is released or the quarterly reports come out, the market might have already reacted based on the buzz or the feeling leading up to it, right?
Precisely. These tools leverage technology to process just vast amounts of unstructured data, the conversations happening online, the news flow, the search queries people are making to try and extract insights about the prevailing mood.
And artificial intelligence plays a big role here.
Increasingly, yes. AI is playing a critical role in making this analysis possible and also more nuanced.
Okay, let's explore some of the specific tools mentioned in that source. Where can someone actually look to try and see what the market is feeling?
Well, a simple yet surprisingly powerful tool that taps into collective curiosity is Google Trends. Now, it wasn't initially designed for finance, obviously.
Right, you can track searches for anything.
Exactly. But it allows you to track the search frequency of particular stock tickers or company names or market-related terms over time.
So if I see a sudden spike in searches for a company like, I don't know, Tesla stock, maybe right before a major announcement, that might indicate heightened public interest or anticipation.
Exactly. Analyzing those search spikes can act as a kind of proxy for increased investor attention or anticipation. The source notes that visualizing search interest through graphs, comparing search volumes for different stocks, can offer insights into which companies or sectors are currently capturing the public's imagination or maybe their concern.
So a sudden surge in search volume might precede price movements.
It might indicate buying interest, yeah, or it could signal curiosity driven by recent volatility, maybe indicating fear or confusion. It just helps investors gauge where the collective focus is shifting.
It's like taking the temperature of public interest online.
Kind of. Moving into more dedicated platforms, we have StockTwits. This is a social media platform specifically designed for investors and traders. Users share short messages, ideas, often tagging specific stocks with a ticker symbol.
So it's like a concentrated hub of investor chatter.
Yeah.
Almost like Twitter, but just for stocks.
Pretty much, yeah. And it provides a very immediate feedback loop on investor opinions and, importantly, emotional reactions to specific stocks. The source describes it as tapping directly into the emotional pulse of the market community for individual stocks.
Okay.
You can see whether the conversation around a stock is predominantly positive. They often use tags like bullish or negative, bearish in real time. It's very raw, unfiltered, and reflects that immediate street-level sentiment.
You're really seeing people's gut reactions and the popular narratives as they form, almost lived.
Exactly. Then there's Centify. This is a more sophisticated platform that aggregates data from a much wider range of sources beyond just dedicated investment forums. It pulls information from global news articles, broader social media platforms like Twitter and Reddit, and financial news sites.
So it's casting a wider net, looking across different types of online conversation.
Exactly. And critically, as the source points out, Centify doesn't just count positive or negative keywords. It leverages advanced natural language processing, often using AI, to analyze both the factual content and the emotional undertones within the text.
So it's trying to understand the feeling behind the words, not just the words themselves.
Right. This allows it to provide a more nuanced understanding of sentiment. It can potentially identify emerging trends, spot potential risks early, like maybe widespread negative social media attention on a company before it hits the mainstream news, and gauge the intensity of feelings around specific market events or stocks.
This sounds like where AI really shines, sifting through just mountains of text to understand the nuances of human language and emotion.
Absolutely. The source highlights that AI is crucial for these tools because it allows them to process the sheer volume and complexity of data involved. I mean, think about the millions of news articles, tweets, forum posts generated every single day.
It's impossible for a human to read all that.
Totally. AI algorithms can rapidly analyze the language used, not just keywords, but context, tone, phrasing, to identify patterns in sentiment at a scale impossible for humans. This enables these tools to provide more accurate and timely insights into market mood, potentially improving forecasting based on this behavioral data. The benefits of AI for predicting stock price movements, mentioned in the source, are heavily tied to this ability to analyze sentiment from these vast textual sources.
So AI isn't just crunching the traditional numbers like PE ratios, it's helping us understand human feeling on a massive scale.
Precisely. It's attempting to turn the qualitative, often fuzzy concept of sentiment into quantitative data points that can be tracked and analyzed over time.
And are there tools that look at sentiment on a broader, maybe macroeconomic level, beyond just individual stocks or social media chatter?
Yes, a notable example mentioned is the SF Fed's Daily News Sentiment Index. This is a high-frequency economic indicator produced by the Federal Reserve Bank of San Francisco. It measures the overall sentiment reflected in economics-related news articles published in, I think, 24 major U.S. newspapers.
So this is analyzing the tone and content of traditional financial journalism, like the Wall Street Journal, New York Times.
Correct. It uses sophisticated lexical analysis, essentially, counting and weighting words associated with positive or negative sentiment within these articles to generate a daily index value. A higher index value indicates more positive sentiment in the news coverage, while a lower value reflects more negative sentiment.
Interesting. So what does that tell us?
Well, it provides a macro-level time series that tracks how the media's overall tone about the economy is shifting. And that tone can both reflect and potentially influence broader investor and consumer sentiment.
That's fascinating looking at the sentiment embedded in the reporting itself. It gives a different perspective than just the raw chatter of social media, doesn't it?
It definitely offers insight into the narrative being presented in those traditional, often influential channels. And that narrative can have a significant impact on shaping public perception and, subsequently, the market mood. The source also briefly notes other tools like the Bloomberg Terminal, which is a really comprehensive platform used by professionals that includes various sentiment indicators built in, and Datamere, which uses AI to scan diverse sources for real-time alerts about events and the associated emotional reactions.
Wow. So it's clear there's a whole sophisticated ecosystem developing to try and quantify and track this powerful but kind of intangible force of sentiment.
Because, as we've discussed, ignoring sentiment means ignoring a fundamental driver of market movements, especially those dramatic swings we talked about. Having tools to monitor it, however imperfectly, is increasingly important for anyone trying to understand market dynamics.
Okay, we've talked about investor psychology, the collective market mood, and how we try to measure it. But there's also some really interesting new research that looks at the sentiment of a slightly different group, ordinary consumers, maybe not active traders. And it offers a surprising twist on what their expressed sentiment might actually mean.
Yes, that recent research from Vanderbilt Business, discussed in the source titled Market Swings and Investor Uncertainty, delves right into this. It really challenges a common interpretation of consumer surveys, particularly those asking about their stock market expectations.
What was the common interpretation, and what did the research find that was different?
Well, the traditional assumption is pretty straightforward. When consumer surveys, like those included in big confidence indexes, show that people expect low returns from the stock market over the next year, it's generally interpreted as widespread pessimism about the market's future performance.
Okay, seems logical. People say they expect low returns. They must feel negative about the market's prospects, like a bearish signal from the public.
That was the conventional wisdom. But this new research suggests that while the reported expectation might be low, the underlying reason might not actually be pure pessimism about the market itself.
Really? So what else could it be?
The study provides compelling evidence that consumers' low stock market predictions may stem more from a lack of confidence in their own ability to accurately predict the market's complex movements.
Whoa. Okay, and unpack that. So it's less, I think the market is definitely going down, and more like, I have basically no idea what the market will do, and I don't trust my own guess, so I'll just give a low number to be safe or look reasonable.
Exactly. That's the core finding. The study's design was quite clever. In Study 1, they first confirmed the standard finding. Consumers' reported expectations for market returns over the next year were indeed significantly lower than the market's historical average performance. That's what normally leads to the consumers are pessimistic conclusion.
Okay, so confirm the starting point. That's what the surveys usually show.
But then, Study 2 offered a critical test. They asked different groups of people similar questions, but varied the framing slightly. They asked some about the likelihood of the market increasing over the next year, and others about the likelihood of the market decreasing.
Okay.
Now, if people were truly pessimistic, you'd expect them to assign a low probability to the market increasing and a high probability to it decreasing.
Right, that would show consistent negativity. A clear bearish view.
But that's not what happened. People gave similarly low likelihood numbers whether they were asked about the chance of the market increasing or the chance of it decreasing.
Huh. That's weird. Assigning a low probability to both outcomes.
Exactly. It strongly suggests that the responses were driven by uncertainty or a lack of confidence in their ability to forecast, rather than a firm belief that the market would fall. The low number wasn't a prediction of doom, but more an expression of, I don't really know how to predict this complex thing. And it also highlights how sensitive reported sentiment can be to question wording, even when you're trying to measure the same underlying feeling.
That's a fascinating distinction. It means policymakers or analysts interpreting these surveys might be misreading the public mood entirely. They see low expectations and think pessimism.
When it might actually be uncertainty or lack of confidence.
Yeah.
Precisely. And Study 3 provided further confirmation. The researchers conducted experiments where they subtly manipulated consumers' confidence in their own forecasting ability, for instance, by giving them some easy predictive questions first to kind of boost their confidence.
Okay.
When consumers' confidence was boosted, they reported significantly higher expectations for the stock market's performance. This really solidified the finding that a lack of confidence in one's own ability to predict complex phenomena like the stock market tends to depress reported expectations, regardless of any underlying fundamental views about the market's actual health.
So my reported expectation isn't just about what I think the market will do, but it's also heavily influenced by how confident I feel in my ability to even have a valid thought about it in the first place.
It adds that crucial layer of self-perception, yeah. And the implications of this are pretty significant, both for individuals and for broader economic analysis and policy.
How does this affect consumers directly then?
Well, for individual consumers, this inherent uncertainty, especially if it's unaddressed, can lead to overly cautious financial decisions. If you lack confidence in predicting market growth, you might keep too much money in, say, low-yield savings accounts instead of investing for the long term.
Potentially missing out on growth needed for retirement, for example.
Exactly. Missing out on potential long-term wealth accumulation, it can also influence day-to-day behavior, maybe leading to changing consumption patterns, perhaps delaying a large purchase, or stocking up on goods out of a general unquantifiable sense of unease, just because things feel uncertain. The research subtly underscores the immense importance of financial literacy and just building basic confidence in understanding how markets work. It's not just about knowing facts, but about feeling equipped to engage.
So my own uncertainty can lead to real, potentially costly decisions that impact my financial future.
It absolutely can. And for policymakers, this research presents a significant challenge. They often rely heavily on consumer confidence surveys to gauge the economic mood and make policy decisions.
So it's a key input for them.
But if survey responses about stock market expectations are being significantly skewed by respondents' lack of confidence in their own forecasting ability, rather than a genuine assessment of the market's health or the economy, then policymakers could be basing crucial decisions on misinterpreted data.
Yeah, they might see low stock market expectations in a survey and think it confirms a need for, say, aggressive stimulus because they believe consumers are extremely pessimistic.
When in reality, people might just be saying, I don't know, in a particular way that gets coded as pessimism.
Precisely.
This could lead to unnecessary or misdirected interventions, or perhaps lead them to fail to communicate effectively because they misunderstand the public's actual underlying concerns or feelings.
It really underscores the need for careful, thoughtful analysis of survey data and highlights how important question framing is to truly understand the underlying sentiment.
Definitely.
And the source notes that this research is particularly relevant in the current market environment, referencing the context of the Trump administration when this research was conducted. And again, we're stating this neutrally as the source's context, not taking any political stance here.
Yes. The point being made is that in an era where market participation is arguably more accessible to individual investors through easy trading apps, and where there's constant, often conflicting market news across traditional and social media.
Information overload.
Right. Ordinary Americans might be more frequently confronted with their own lack of deep financial expertise and thus their own uncertainty about predicting market movements. This environment could potentially amplify the effect identified in the research, making a lack of confidence an even more significant driver of reported expectations than perhaps in the past.
So the very accessibility of markets and information might ironically be highlighting our own perceived shortcomings in understanding them, leading to these lower reported expectations.
It's a fascinating angle, isn't it? It adds another layer of complexity to understanding sentiment, suggesting it's not just about greed or fear, but also about self-awareness, uncertainty, and our perceived competence, or lack thereof.
This has been incredibly illuminating, really, from the raw power of those big market swings to the hidden biases working within us, the tools trying to measure the mood, and even these surprising nuances of consumer uncertainty. Given all this, how can an investor actually use this understanding of sentiment and psychology? Is there a practical strategy that's based on these insights?
Absolutely. This knowledge really forms the foundation of an investment strategy known as contrarian investing, which is explored in the FMP source we looked at. It's an approach that directly seeks to capitalize on the market inefficiencies and overreactions driven by precisely the psychological factors we've been discussing all this time.
Contrarian.
Yeah.
So you're consciously going against the flow, deliberately betting against the prevailing sentiment.
Precisely. The core principle is beautifully simple, yet, as you might guess, psychologically very demanding. You aim to buy assets when the collective market sentiment is overly fearful and driving prices down unfairly, and you look to sell assets when the market sentiment is overly greedy or euphoric, driving prices up to unsustainable levels.
That sounds like it requires a really strong stomach and a lot of independent conviction.
Yeah.
You're zigging when everyone else is zagging.
It absolutely does. The strategy is based on the belief, which is strongly supported by all these behavioral finance findings, that human emotions cause markets to frequently overreact to news and events, pushing prices too far in one direction or the other.
Creating those inefficiencies.
Exactly. These overreactions create opportunities for investors who can remain rational, while others are being driven by emotion. The FMP source outlines the key principles. First, capitalizing on market overreactions fueled by temporary emotions like panic or euphoria. Second, maintaining a steadfast focus on the fundamental strength of a company or asset rather than getting swept up in the short-term mood swings. And third, requiring a long-term perspective and considerable patience, because it often takes time for market sentiment to correct itself and for the underlying value to be recognized by the broader market.
This is basically the embodiment of that famous quote from Warren Buffett, isn't it? Be fearful when others are greedy, and greedy when others are fearful.
That quote is practically the unofficial motto of contrarian investors. It perfectly captures the essence. It's about having the discipline and the conviction to act decisively when the market seems ruled by emotion rather than logic.
Okay, so if you want to try and be a contrarian, how do you actually identify opportunities? How do you spot a stock that's cheap because of irrational fear and not because the company is genuinely failing? That seems like the hard part.
That is the critical distinction, yes. The source highlights several indicators contrarian investors often look for when hunting for potentially undervalued assets where negative sentiment might have created a buying opportunity. One common indicator is a low price-to-earnings (PE) ratio, especially when compared to the company's own historical average or its industry peers.
So the market is valuing each dollar of its earnings less than it is for similar companies, or less than it used to.
Right. A significantly depressed PE might signal that the market has lost confidence in the company's future earnings power, possibly due to temporary bad news or just general pessimism, even if the long-term outlook might still remain solid.
Okay, what else?
Another is a low price-to-book PB ratio. A PB ratio below 1, for instance, means the stock is trading for less than the net liquidation value of the company's assets on paper. Now, sometimes that's justified for really troubled companies,
Sure.
but it can also indicate extreme market pessimism that has pushed the price below the tangible value of the business itself, presenting a potential bargain if the company can recover or if that pessimism is overdone.
It sounds like the market is saying the company's parts are worth less than the whole entity.
Exactly. Contrarians also sometimes look for companies with a high dividend yield, particularly if the stock price has fallen significantly while the dividend hasn't been cut. A high yield might suggest a company with robust cash flow that continues to pay dividends, but whose stock price has been unfairly punished by negative sentiment, making the yield look very attractive relative to the depressed price.
Assuming the dividend is sustainable, of course.
Crucial assumption, yes. What about what analysts or company insiders are doing? Does that play a role?
Oh, definitely. That's key, too. Contrarians pay close attention to company ratings and analyst sentiment. They look for situations where maybe the consensus analyst view or the media coverage is overwhelmingly negative, but perhaps one or two independent analysts maintain a positive outlook, or the underlying company ratings based on fundamental strength remain reasonable despite the noise.
Sort of looking for needles in the haystack of negativity. Kind of. It suggests an opportunity that most people might be overlooking because they're caught up in the prevailing negative mood. Similarly, observing insider buying when executives or directors are purchasing company stock with their own money can be a very powerful signal.
Why is that?
Well, if people who have the most intimate knowledge of the company's operations and prospects are buying shares when the stock is depressed and sentiment is negative, it can indicate their confidence that the market is wrong and the stock is actually undervalued. They're putting their money where their mouth is.
That makes sense. And institutional buying.
Large institutional buying when prices are low can also be a sign. If sophisticated investors, like big funds, start accumulating shares when the price is down and fear is high, it might suggest they see long-term value that the fearful retail market is missing.
So taken together, these are the sorts of clues that might suggest a stock is suffering from a temporary sentiment problem, not necessarily a permanent, fundamental one.
Precisely. They help build the case that the negativity is perhaps overdone. And the FMP source provides some classic, well-known examples of successful contrarian plays based on these ideas.
Like who? What are some examples?
Well, the source mentions Warren Buffett's investment in Bank of America back in 2011. This was during the aftermath of the financial crisis. The entire banking sector was just reeling from negative sentiment, huge regulatory uncertainty, and widespread fear. Bank of America's stock was incredibly depressed.
Yeah, people thought banks were toxic.
Exactly. While many investors were running away, completely overwhelmed by fear, Buffett's Berkshire Hathaway invested $5 billion in preferred stock with warrants, essentially injecting capital at a time of maximum pessimism. It was a classic contrarian move, buying into a fundamentally important, albeit troubled, institution when sentiment was truly at rock bottom. And that investment proved incredibly profitable as the sector, and Buffett itself eventually recovered.
He truly embodied that greedy when others are fearful maxim there.
Absolutely. And another example mentioned is Apple's situation in the early 2000s. After the dot-com bust and before the launch of revolutionary products like the iPod and later the iPhone, Apple was largely seen as this struggling niche computer company, lagging far behind competitors like Microsoft.
I remember that. People were writing them off.
Sentiment was decidedly negative. Many analysts dismissed them. Investors who recognized the underlying strengths, the loyal customer base, the design focus, the potential under Steve Jobs' leadership, and who bought shares back then when market sentiment was so low, they were making a deeply contrarian bet. And obviously that paid off spectacularly as Apple transformed into one of the world's most valuable companies.
Those are really powerful illustrations of the potential rewards, but it still sounds incredibly difficult in practice.
Yeah.
What are the major risks or challenges of trying to be a contrarian investor? It can't be easy.
No, it's definitely not easy. The FMP source is very clear that it's not without significant hurdles. One major risk is falling into what's called a value trap.
A value trap.
Yeah. Sometimes a stock is cheap and sentiment is negative for a very legitimate fundamental reason. Maybe the business model is truly broken, or management is incompetent, or the entire industry is in terminal decline. Buying a stock just because it looks cheap on paper without thorough due diligence on the actual fundamentals can lead you to invest in a company that will never recover. It's cheap for a very good and permanent reason.
So you have to be really sure the negativity is temporary or purely emotional, not reflecting a terminal problem with the business itself.
Exactly. Rigorous fundamental analysis is still crucial. Market timing is also incredibly difficult, maybe impossible to do consistently. Even if you are ultimately right that a stock is fundamentally undervalued due to temporary negative sentiment, there's absolutely no guarantee or clear timeline for when that sentiment will shift and the market will recognize the true value.
You could be right eventually, but be waiting a long, long time.
A very long time, potentially years before the investment pays off. Which leads directly to another massive challenge: the psychological pressure. Going against the prevailing market trend is lonely and stressful.
I can imagine.
When everyone else is panicking and selling, buying requires immense psychological fortitude and deep conviction in your own analysis. You will almost certainly look wrong for a period, possibly a long one, and resisting the urge to follow the herd, especially as you watch your paper losses mount, is extremely difficult for most people.
It really takes a unique mindset to be comfortable being an outlier, especially when you're losing money initially.
It absolutely does. And finally, as we touched on, patience is absolutely required. Contrarian strategies are inherently long-term. They rely on the market eventually correcting its emotional overreactions. This is definitely not a strategy for quick gains. It demands the ability to hold positions, sometimes for years, through periods of continued negative sentiment and potential further price declines, just waiting for the underlying value to eventually be recognized.
So while contrarian investing offers a way to potentially profit from the market's behavioral quirks, its psychological roots, it demands rigorous analysis, tremendous emotional discipline, and a very long-term horizon. It's really a strategy built directly on understanding the human element we've explored, recognizing how emotions distort others' decisions, and having the discipline to manage your own emotions to do the opposite.
It's definitely one of those direct applications of understanding market psychology in actual investment practice.
Wow. This has been a truly expansive deep dive. We started with those dramatic, almost unbelievable, history-making market swings, recognizing they're often driven by more than just the numbers on a page. We peeled back the layers to understand the fundamental psychological biases lurking within us that contribute to these movements. Biases like overconfidence, herd behavior, loss aversion, anchoring, regret aversion. seeing how they distort rational decision-making and collectively impact market volatility.
Yeah, the machinery inside our heads.
Then we explored the fascinating world of real-time sentiment analysis tools, from simple things like Google Trends to sophisticated AI-driven platforms, all attempting to measure this elusive collective mood.
Trying to quantify the feeling.
We even uncovered that surprising new research showing how ordinary consumer pessimism might actually be rooted more in a lack of confidence in their own forecasting ability, adding a whole new wrinkle to interpreting market sentiment data.
The uncertainty factor.
And finally, we look at how a strategy like contrarian investing actively tries to harness these human-driven market forces, buying when others are fearful and selling when they get greedy.
The overriding key lesson from this whole journey through our sources seems really clear. Investor psychology isn't just some abstract academic concept, or some soft factor to consider after you've done the fundamental analysis. It is a powerful, tangible, and dynamic force. It directly impacts asset prices, it drives market volatility, it contributes to those market inefficiencies, and it's a significant, often primary factor behind those major history-making market swings we started with.
Understanding it is absolutely crucial. And it's not just knowledge reserved for professional traders with advanced degrees and expensive Bloomberg terminals, right? It's essential knowledge for you, the individual investor, as you navigate your own financial path.
Absolutely.
Recognizing your own potential biases, being aware of the collective emotional climate swirling around, and understanding how these human elements shape the financial landscape that seems fundamental to making more informed, more disciplined, and potentially more successful decisions in a market that is really, at its heart, just a reflection of human hopes and fears.
It's really about realizing that being a successful investor involves not just analyzing companies, but also understanding people, and maybe most importantly, understanding yourself.
So here's maybe a thought to leave you with, building on everything we've discussed today. If human psychology is such a dominant and complex driver of market behavior, leading to both predictable biases and these surprising expressions of uncertainty, and if artificial intelligence tools are rapidly becoming more sophisticated at analyzing, quantifying, and maybe even predicting that sentiment from the sheer vastness of human communication.
Where is this heading?
Yeah, how might the future of investing be shaped by this evolving interplay between very human emotion and increasingly powerful artificial intelligence? What does that growing sophistication of AI sentiment analysis mean for the individual investor trying to make rational choices when the very mood of the market is being dissected, maybe even anticipated by machines?
It raises some really deep questions, doesn't it, about the future landscape of finance and, well, our place within it as human investors. Something definitely worth considering as you reflect on your own investment journey.